Welcome to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit Franklin Youth Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Monday, January 30th, and joining me as always is my friend and partner, Dr. Orphe Divounguy, PhD economist. Dr. O, going to jump right into it with the Fed meeting. It's tomorrow, and in theory, potentially Wednesday too, but we should probably know what's going on. What should we expect? And then we're going to talk about the other data that's coming out this week. Lots to catch up on.
The Fed has seen what's going on, has the same data, is clearly seeing inflation decelerating rapidly. We talked about GDP last week, and, the headline number is pretty good, pretty solid. The, households are kind of withstanding the rate hikes and the fact that inflation is still pretty high. The prices are extremely high compared to where they've been in 30, 40 years. But, when you look into under the hood, right, and you look at domestic sales, they've gone down to 0.8%, which really means that there's very little the consumer is really holding on. And so the Fed, I think, is aware of that. The economy is slowing rapidly, and consumption makes up 70% of GDP. And so if the consumer is barely holding on, we're right at the edge. And so this possibility of a soft landing, yes, still possible. But I think the U.S. economy is headed towards that recession that we've been talking about so much. Now, of course, there's some good news, I would say. The good news is that the Fed still has a lot of control. Monetary policy impacts the economy with a lag. And so we know that perhaps they don't even need to do that much more to get us to land safely. The Fed is likely going to raise its key policy rate by 25 basis points. That's a consensus. I think the Fed still thinks it has a long way to go. I'm one of those people that thinks, given the long and variable lags of monetary policy, maybe much more isn't necessary. Inflation is coming down rapidly. We're at 6.4% now. Remember, inflation's a moving target. It's falling rapidly, and trying to get the Fed funds rate above that CPI number could end up being costly. Now, you look at the other data, the other price index the Fed looks at, the PCE, Personal Consumption Expenditure Price Index. It's also declined. Things are moving down. Inflation expectations have fallen. Wage growth is at 4.5%. I am not convinced that at this point that further tightening, yes, we do need to tighten it a little bit more, but I am not sure that going above 525, 550 is going to be necessary. And we're going to see it, right? We're going to keep watching it. Those numbers are going to keep coming in. February employment is going to be up. It's going to come up on Friday. We're going to have the January employment on Friday. We'll know exactly what's going on with earnings. And then we'll have the CPI, of course. And so, yeah, the data's coming in.
So let me ask you this. What is the concern about over tightening? Obviously, from the standpoint of like at a retail level, borrowing and it costing more money, nobody would sign up willingly for that, right? Your interest payments go up. In theory, your exposure is increased. But if for the benefit of like in the macro sense of what's going on in the U.S. economy,
it's millions of people losing their jobs. Okay, that's the big cost. The cost is hiring has already slowed, but layoffs remain somewhat low. Now, if you listen to pundits, on Wall Street, everybody's talking about white collar recession. You have all the high income folks in the tech space, a lot of high income folks in the tech space losing their jobs. And these people buy a lot of stuff. Now, they're high income people, right? They buy goods and services. And the sector is already slowing down tremendously by our ISM indicators, the manufacturing index. The service sector is already slowing down. Now, all you have to do is take away more of that high income, those high income consumers from the table. And of course, demand weakening in those sectors that are still doing somewhat okay will result in less hiring and potentially layoffs, more layoffs. in some of these other sectors of the economy that haven't been quite affected just yet. I think that's the worry, right? The soft landing implies a decline in hiring, a softening of the labor market without a surge in the unemployment rate. Once the unemployment rate starts to increase, we're potentially going into recession territory. And yes, most people believe the recession will be mild. I just don't want to take a chance. We could still get the plane landed safely, I believe. And it's just a matter of the Fed making sure that it does not do too much. Remember, market rent leads CPI rent. Rent in CPI makes 40% of core CPI. And rent has come down substantially. It's still on the way down. I think we're going to get to a point where prices have fallen. And so, we're seeing the inflation come down. It's going to support the purchasing power of consumers.
So there's the data. There's the theory. Now time for the fearless Orphe forecast.
The fact that inflation is coming down will support the purchasing power of consumers, but consumers are not spending. In the latest report, the latest data that we got last week, what we saw was inflation had come down. Personal income went up in December, but savings increased, meaning consumers are choosing not to spend. And the risk is that we could end up talking ourselves into a recession. Remember, consumer sentiment can exacerbate business cycle fluctuations. And so if people are nervous about the future, even if you see this increase in purchasing power, if people are nervous about the future, they'll stop spending. And then the Fed will be in trouble because, we will end up in that recession and miss the runway altogether. So those are the fears. And those are the things I worry about. I think we should tighten a little bit more, but we have to be careful not to tighten too much. 25 basis points is probably still in the cards this week. And then we'll have to sit back and watch and see all that new data coming in and recalibrate. And I'm one of those people that I'm starting to think the Fed might have to recalibrate later on during the year because they may end up doing too much.
All right, I'm with you. I think it's going to be a quarter point. We'll have to see. We won't have to wait too terribly long. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.